Hi, and welcome back to the Business Career College video series. In this video, we're going to look at the calculation of premiums for a life insurance policy. This is quite appropriate for students going through the life license qualification program. Also, probably useful for a student going through a financial planning course. So when we look at premiums for a life insurance policy, we're going to look at three or arguably four factors. We're going to look at mortality, and if we were dealing with a disability policy, we would refer to this as morbidity. So mortality is the likelihood of dying at a given age. Morbidity is likelihood of becoming disabled at a given age. We also will look at the insurer's expenses, and we also have to consider the insurer's or the investment component of a policy. And there is a fourth factor. It's not something that's covered in any detail in the life license qualification program, but lapse, and I will talk about it at least for a few moments near the end of this presentation. We'll look at lapse very briefly. Mortality, however, is by far the most important consideration. And mortality is going to be based on somebody's age, somebody's sex, and somebody's smoking status. And based on this information, actuaries create tables referred to as mortality tables, or sometimes you'll see them referred to by their correct name, which is the commissionaire's tables. And these mortality tables, they are proprietary information. In Canada, the Canadian Institute of Actuaries prepares these mortality tables, and they're really offered to insurers exclusively. They're not public information. So the mortality table describes for us the likelihood of somebody dying at a given age based on these factors. And the way this mortality table works, it uses a sample, generally a sample of 1 million people, and it says at a given age, so let's start with age 0. At a given age, how many out of this million might die? So it's typically, and not sort of a depressing topic here, but typically 3,000 out of 1 million might die in that first year, giving us a mortality rate of 3. So we have deaths per 1,000, then we'd have 3 deaths per 1,000. Now, next year, our sample size would be less than 1 million. Our sample size would have come down, and now our sample size would be just 997,000 of them. And then we say, okay, out of that 997,000, how many would die? And the next year it would be substantially less. It might be 1,000 that would die. And then we could say that gives us a mortality rate of 1.00. Now, let's fast forward a little bit here, and we'll look at mortality. Let's say that we have a male non-smoker, and we're going to see the mortality tables broken down like this by sex. So you'll have different mortality tables for men than for women, and we'll see either smoking or non-smoking status, giving us 2 separate sets of mortality tables. So a lot of times we say somebody's rated for smoking, but that's not true. They're actually on a separate mortality table. And let's say that our male non-smoker is age 44, and at age 44 our mortality table might show that we're going to have 3 deaths for every 1,000 insureds, or life insureds, sorry, or lives insured. And my male non-smoker wants to buy, we'll just keep this nice and easy, $100,000 of life insurance. And life insurance is only sold in blocks of $1,000 or in units of $1,000. So we're not going to have somebody buying $100,408 of life insurance. 100,000 is a nice round number. So we want to know what this is going to cost. Well, what we have here, this would be 1,000 units of insurance. Sorry, I apologize, it's 100 units of insurance. So now we have to look at what each unit costs. Well, at a mortality rate of 3 for every 1,000, the insurer knows then that they have to collect $3 per unit. So this is going to have an annual premium of $300. And that covers our mortality cost. Now, not every life insured who's acquiring insurance is necessarily at the optimal level of health. So this is where the insurer looks at this and says, now we have to apply a rating. So if we have this person with a $300 premium, that's what we would refer to as their 100% rating. That's the insurer's cost when this person is acquiring insurance at a healthy sort of normal rate. We can have superior ratings. Sometimes we have somebody who actually represents a lower degree of risk and they might get a discount off of this, but let's say that this person happens to represent a little bit more risk. Maybe they have some health problems in their history, or maybe they have some dangerous hobbies or something like that. So that's where we might attach, let's say, a 150% rating. And that means now the insurer figures this person is about 50% riskier than their normal amount of risk. You'll see ratings usually up to about 400% is as high as insurers will go. I have heard of instances of ratings going as high as 500%, but usually 400% is the top end. So this person, instead of paying a $300 premium, is now paying a $450 premium, and that's just for their mortality costs. Or this is what we might refer to as the cost of insurance. That is, what does it actually cost to buy the insurance in this case? Now, in addition to that, we'll typically have some expenses associated with this policy, and that's assessed in the form of a policy factor or a policy fee. So let's say, for the sake of argument, that we have a $60 policy fee or policy factor. That's how the insurer recovers its expenses. Because if they only charged that mortality cost, that $450, and the expected number of people die, the insurer is going to be out all of that money. So now we have a premium of $510. And if this were a permanent insurance policy, then we would also add something in here for the investment component, but we'll just use term insurance here for the time being. But if this were permanent insurance, we would add some investment component into here. But let's just leave this at $510. Now, the other thing that does happen is that we can incorporate lapse into these policies. It's actually a good thing to some extent for the insurer when a policy lapses, and insurers do count on this. Insurers count on a number of people lapsing their policies when we get to maybe year 8 or year 10 or year 12 of the policy. And if that happens, then really the insurer comes out ahead, because that's somebody who paid a number of years of premiums, and now no death benefit has to be paid on that person's behalf. So we can incorporate those lapse assumptions into our calculations, and normally lapse assumptions are somewhere around 1 to 3%. That is, we assume that somewhere between 1 to 3% of a given type of policy will lapse in a given year. And if that holds true, that's generally good for those who stay in their insurance policies. So now we end up at a $510 premium. Now this is what your premium would be if you paid annually. But it's actually pretty rare for somebody to pay their insurance premiums annually, as with a lot of costs, we might choose to pay this premium monthly. And what happens then is it's assumed that you paid this $510 in advance. So we assume this is paid in advance at the beginning of the year. So then the insurer has that money available to pay claims out throughout the year. If you don't want to pay it in advance, that is, if you want to pay it monthly, then we're going to add a policy fee or a policy factor. And this policy fee or policy factor might be in the realm of, let's say, 8%. So now we have an 8% policy fee added onto this insurance policy. And if you're doing this in your calculator, you can do 510 plus 8%. With most calculators, that'll give you your answer. And you'll see that the total annual premium now will be $550.80. And now you're going to pay that monthly. And this amount, this 8%, sorry, that's not policy fee, I apologize. That's your, sorry about that. That's what we call the modal factor. We saw the policy fee up above. So this modal factor, this 8% modal factor, means you're using a mode of premium payments other than annually. And now we take that $550.80 divided by 12, and your monthly premium for this $100,000 of insurance for a 44-year-old male, and this would assume a 1-year non-renewable term policy, will be $45.90 per month. Now, when we get later into this course, we'll see that there are some things we can do to create different types of insurance or to average out this cost over a number of years. But for now, this 1-year non-renewable term insurance policy would have a monthly premium of just shy of $46. That's what it would cost using these calculations for $1 million of insurance. Sorry, $100,000 of insurance. I hope that helps to understand the calculation of premiums. A little bit of math in there, but it's mostly about the concepts. And I hope you enjoy your ongoing studies. Thank you very kindly.